Welcome to session 4. In this session we're looking at accounts for double entry. Now we're going to start by revising what we covered in session 2. And in session 2 we were looking at the accounting equation. And we said that the equation states that assets equal capital plus liabilities. In other words, the sum of all the assets must equal the sum of all the capital, the funds that have been introduced in the business, plus any financial obligations that the organization has, such as loans. Okay, so they must equal. Okay, now let's build on this. And we're going to look at accounts for double entry. And we've got in front of us what is called a T account. Now you need to understand that in accounting, initially transactions are recorded in a T account. As you can see, it is T-shaped. It's a ledger account. It's a graphical representation of a ledger account. And on the left-hand side of the T account, we record debit entries. And on the right-hand side, we record what we call credit entries. Okay, let's move on. Now we've got 3 columns in front of us. The one on the left reads accounts. The one in the middle says to record, and the one on the far right-hand side reads entry in account. And we want to look at the different families of accounts and how they are affected when they increase or decrease. Let's start with assets. When an asset increases, we debit the account. When an asset decreases, we credit the account. When a liability increases, we credit the account. When a liability decreases, we debit the account. Let's look at capital. When a capital account increases, we credit the account. When it decreases, we debit the account. When an expense account increases, we debit the account. And when it decreases, okay, fantastic.